Anna, I don't know if you heard, but half the year is over. We are now in the back half of 2023. I cannot believe it. I thought
Me
we should take an
either.
assessment of where we are, talk about inflation, talk about the economy, recession odds, the Fed, whatever you want to talk about. When you look at the second half and what we've just been through, what has surprised you and what do you see in front of us?
Yeah, it's interesting. I think we have been talking about this for probably a year and 3/4 at this point, right?
Probably,
The
yeah.
the the slow moving train that has been from transitory inflation to sticky inflation to starting to, come down a little bit. So it has surprised me quite how long this has taken for us to get to the point that we are, and for the Fed still to be talking about rate hikes. So
Mm,
I think about this time last year, I would have expected that, within a year, maybe we'd have a hold of inflation.
mm,
But more and more evidence has shown us that there's parts of the economy where inflation is going to remain sticky, such as in wage inflation, energy inflation, due to deglobalization and things coming back on shore. And both of those things will, I believe, result in longer, higher inflation than a 2% normal over a long period of time. So I do tend to think that while inflation's coming down quite a bit,
mm,
a lot of areas of the economy are very deflationary right now, but we still have very strong wages and we still have high, low
yeah.
unemployment at this point. And so those two things are really what the Fed was hoping to take a bigger hit to bring inflation down more quickly. And the economy's proven to be pretty resilient in the job market. So I think that we're probably in for, at a high level, another one or two rate hikes, another half a point probably. And then I think the Fed, really, really pauses unless they break something and they pivot. So we're kind of more of the same of where we were a quarter ago. I
Mhm.
just think that the numbers that are coming out make it a higher probability that the Fed raises rates than the last time that we talked about this.
Yeah, it's very interesting because I put out an opinion, which I won't change because I want to be held to it. Is I think this is all theater. I think Jerome Powell is doing his best to talk tough. I
Yes.
think we're going to get a shockingly low CPI reading next week, and they're going to pause in July. I don't think there's another rate hike out there. Although I will tell you, with the numbers that have been coming out the last week, I feel less good about that. And oh, by the way, let's not forget the market says 87% chance of a rate hike. So I'm definitely on a very small island with
Yes,
very
you
few other
are.
people.
You are.
It's
And I
okay.
love when we
I enjoy it.
disagree sometimes, right?
Yeah.
Because the reality is that there are so many different numbers that could go kind of either way. And I will say this, although Powell has been talking tough and been more and more hawkish, the pause didn't come as any real surprise because they said, rate hikes are going to take at least a year to trickle through the economy. And so we're about a year in, and it's like we got to see where things go. And a longer pause wouldn't shock me, but I will say that the majority, when you look at the press release that came out after the last rate hike, the majority of the FOMC think
Mhm.
they need to raise rates by another half a point. And so I think because of that, I don't see any data that's shifted so much from last month that makes them say, oh, we don't need to do that anymore, when the majority of the Fed governors who have a vote actually think that we need more. So it's
Mhm.
definitely interesting times. I think that they do raise rates in July. If I had to bet, I would raise it. They do,
Good.
but I don't think they go more than about a quarter a point,
Yeah.
because they know, again, they're not just looking at data points for today. They're looking at longer term. Do we think inflation's going to be stickier? And I have been surprised, Michael, that they have not come back and changed their 2% as the norm and healthy. I
Mhm.
thought, with looking out in the future and looking at kind of where the longer term global secular trends are for deglobalization and demographic decreases resulting in higher wages, I thought that at this point they might say, 2% may not be realistic going forward in the future because of these things. So if we
Mhm.
can get closer to 3%, but keep GDP above that, we would be happy with that too. I'm just shocked that nobody has talked about that and that they really think that 2% is their target. We're a long way from 2%. And so the only way that they can get us there quickly, I think, is to continue to raise rates and to try to prevent the fallout of a banking crisis and a commercial real estate, loan
Yeah.
crisis. And I'm seeing some things which we can talk about here in a minute that make me think they're trying to continue to raise rates and then backstop all these other things so that
Yeah.
they can really get inflation down to 2% more quickly.
Yeah, there's a couple things I want to highlight here. I think if they do raise, and again, I think the odds are clearly saying it's coming. This is what I actually think. So if they don't raise, I think they can pause for a year. I believe if they raise once and heaven forbid twice, they break something and they cut much, much sooner. I believe those are
Yes.
the two paths that we are on. Don't do it again. Pause for a year. Let all this stuff work out because we're kind of making it work now. We can limp through this. But if they take it up another half a point, it will break something sooner and Powell will cut sooner. That's kind of the
I
trade-off.
agree with you. I agree with you there. I do. I think that's the big risk. If they break the banking system, they're going to choose to save the banking
Of
system
course.
and keep inflation a little bit higher versus the other way around. But
Of
what's
course.
interesting, and I saw this, I think we talked about this on the show. It's probably been about 2 months ago. I don't remember the date, but I saw a briefing on of the U.S. Treasury, and they basically came out and said, we need an emergency meeting of the Treasury and the Fed to get together and to determine how we look at the risks to commercial real estate loan defaults and that trickle down effect into the banking system. So it happened after the fall of SVB and the other banks. So they said, hey, we know that commercial real estate's the next shoe to drop, and if those loans have to be written down, these banks could really start to struggle more so than they are now. So they were talking about it. Well, they just released an article, I think it was Friday, and I haven't read the entire press release, but I read the highlights. And basically, the Fed and the Treasury are coming out to banks and to agencies and saying, we need you and highly encourage you and will support you
I
in
read that.
working out commercial real estate loans. And for borrowers that are good borrowers, we don't want you to let them default despite the fact of what these rate hikes are doing to potential values. And so I think that that's really important for us to realize as they're trying to put these things in place to say, we want to keep raising and we want to stop the harm to the banking system.
Yeah, I read the article. I shared it on the Daily Financial News. Basically, it's a version of extend and pretend. They've identified a segment and said, yeah, here are some new rules that we highly encourage you to do short-term workouts was the term that they used. So again, I think that's there. One more thing on inflation, we'll get onto some other topics. I actually think inflation's about to roll over hard. Again, we'll talk about CPI headline and CPI core. We can do any of the other ones you want, but that's up next. CPI is next week. So I think CPI headline hits 2.9 next week. So it goes from 4 to 2.9. I think there's a chance in the September reading. So this will be 3 readings from today. We have headline at 2.5. Because what happens in August is not only do we have automobiles, which are already rolling over, you'll finally have shelter and their 12-month lagging craziness show up in the August number. So I think headline could be 2.5. Now, what about core? Core today is higher than headline, which is unusual. What is the biggest part of core? Shelter. What's the next? Automobiles. I think there's a very good chance that core is, call it mid 3s, maybe 3-4 by September. Much different than 5 or whatever it was last time. So Bank of America just put out a report that they're like, hey guys, wake up. The math says that inflation's about to fall like a stone. And I don't think enough people look at it because it's just mathematically in the formula. Shelter rose over in August. The July reading, which is 8 days away, we have the largest base effect falling off of the entire 12-month series. So I think inflation is going to shock people with how the numbers that are printed.
Yeah, I think in the short term, it's definitely going to start coming down. And another thing that we've talked about on the show as well is the yield curve inversion. It's just gotten steeper and steeper. And so the first time that it really inverted was July of 2022. And so it's just been exactly a year. And the average recession's been about 15 months from that yield curve inversion, which gets us to about October. So you and I've both been saying we think we're hitting official recession, by that third quarter. There's been a lot of markers, as we've talked about on this show, that are already recessionary. So
Mhm.
the 10 key markers that the NBER looks at to declare a recession, 8 of the 10 have been recessionary for almost a year. So
Almost a year.
it's
Yeah.
just those last two things, wages and unemployment, that are not
Mhm.
recessionary. But they may still go ahead and declare a recession anyway, because lots of other areas of the country are really starting to show more deflationary indicators that are below the recession line, other than those two things. And I think that that's just going to continue to get worse. So
Yeah.
as growth starts to slow, as you start to have these more recessionary pressures in manufacturing, employment, hours worked, things like that, you start to see people taking on, 2 and 3 jobs now in order to make ends meet. I think that starts to pull inflation down as consumers really start to feel the effects of some of these deflationary measures, and that starts to bring, inflation down a bit. So I think that we're getting closer to being done. The
Mm.
question is, does the Fed raise another half a point before they wait? How bad and how deep is the recession?
Yeah.
Still, is to be determined, and that'll determine, where things go from here.
Yeah. And then the last thing we probably should talk about as real estate, and we'll talk residential. Active listings, available stuff for sale, not there. Existing home sales, not coming. We're now entering the slow half of the year. Builders are crushing it, up 12 or 15%, I forget, month on month. Uh, what do you think's going on in residential? Because it's a very odd market.
Yeah, I think, residential and commercial are such different animals right now, right? It's parts of residential in certain areas are struggling, but I'm surprised. You asked what surprised me. I really am surprised that we haven't seen more pressure in the single family home space in terms of values. We knew that because of 80% or more owners having really low interest rates, people don't have to sell, and a lack of supply keeps housing prices up even when demand is waning. So we knew that, but I am surprised how long the single family space has been pretty resilient. We're really only seeing pressures in areas of the country where people are already leaving anyway, and migrating for, lower taxes, lower cost of living, better jobs, etc. And the second home market is just starting to kind of feel some of those pressures as well. But it's been surprising to me just how resilient our housing market has been. And even with that home gauge within CPI, although it is coming down in some areas, there's still rent increases, positive rent increases in lots of areas of the country. And so that could keep, cost of homes still higher than what maybe some people expect in the CPI numbers.
Yeah. It's a lot of fun. We're going to be talking about this every week. Again, folks, if you would love to see a real estate event co-hosted by Anna, REI Mom, and One Rental at a Time, let us know below. We do a week or 10-day cruise, maybe Caribbean, maybe Alaska, who knows. But let us know if you'd come, just so we have a rough number and see what's what. Anna, where can people find you?
Great. You can find me here every week on my website, reimom.com, for coaching and consulting, and on my social media at Anna Kelly, REI Mom.
Thank you so much.